One of the questions that I always get asked is, Obi, should I trade my small account differently from the way that I trade my big account? Guys, I totally believe that at the beginning, this is the wrong way to go. And hear me out. First of all, what you're doing is building two different habits for a career where you want to be, in theory, consistent. Therefore, you want to be doing the same thing all the time. If you're not in a position where you're doing this all the time and you're giving different informations to your brain at different times because you feel that you can go and showboat or do different things with your small account and treat your other account a little bit more serious, I totally believe that you're doing yourself a disservice. You're doing your trading a disservice. Why is that? You need to put yourself in a position where you stop signaling two different things to your brain. Now, when you start messing up on your small account and you want to go back trading your big account in a serious manner, some of those bad habits that you had in your small account can seep into the big account. And we don't want that. We don't want that at all. So at the very beginning of your trading career, treat both accounts the same. The same discipline that you need to trade with $500 is the same discipline that you need to trade with 50,000, 500,000. There is no difference whatsoever. Once you're consistent and you're making money and you're well deep into your conscious way of doing things, then go ahead and do what you want. This may not be mentioned a lot, but you guys need to hear this. You need to be hopeful when the market goes in your direction, and you need to be fearful when the market goes against you. Now, it's going to sound extremely obvious, but as we know, beginner traders don't tend to do that. Beginner traders tend to be hopeful when the market goes against them and extremely fearful when the market goes in their favor. I believe I've learned this from the best loser wins, Tom Hugard. Be hopeful when the market goes in your favor and be fearful when the market goes against you. Why do I say that? Because beginner traders do the complete opposite. They are hopeful when the market goes against them, therefore leaving the market to linger beyond their stop loss or beyond their mental stop loss, which I don't agree with. You should have hard stops, especially at the beginning of your trading career. Believing and wishing and hoping for the market to come back in their favor. But when the market goes in their direction, they're extremely fearful, therefore cutting their profits very early. There was a study that was made and shown in the book Best Loser Wins by Tom Hugard, where for every percent that was put in the market, most times out of 10, all trades will be bigger losers than they were bigger winners, therefore leading traders to actually go broke in the long run. Why is that the case? It's because of the relationship that we have with money. We don't want to lose money. We don't want to admit that we are wrong either. Hence the reason why we tend to get rid of our stop losses or allow the market to completely take heavy losses against us before we decide to crystallize the actual loss. We want to be hopeful. But when it comes to the market going in your direction, you're extremely fearful and you don't want to lose the profits that you have made. Therefore, not allowing the market to move its actual target or not being solid enough mentally to allow the market to build those profits even more, therefore leaving you with very short profits. What you need to do over in the long run is, in theory, collect data, guys. You've got to collect the information to show you that, first of all, you have an edge that works, and you have an edge with asymmetrical risk to reward, which enables you to give you the confidence to cut your losses immediately or cut the losses where they need to be cut and allow the profits to run in the opportune times that the market is moving in your direction. Guys, repetition is the mother of success. What do I mean by that? As methodical, systematic traders, we have a systematic approach which repeats itself with statistical reliability in the market. This gives you an edge that repeats itself with the same variables. This is the magic key in breaking out of the maze of trading, especially for beginner traders. Why is that? This allows you to have a set of parameters that you constantly look for in the market. It removes the guesswork. It removes all of the guesswork, and it enables you to know exactly what these parameters can do and what is their potential edge in the long run. This is the only way to get out of the maze when it comes to trading at the beginning of your trading career. Once you become a little bit more experienced, you can start to add a little bit more discretion or probably be a little bit more intuitive. But at the beginning, the mechanical way of trading allows you to repeat the trading process over and over and over again, which removes the emotional stimuli out of the trading itself. Now, most of our mistakes are not going to be technical. Most of our mistakes for a trading career are going to be psychological. And as we know, trading is 90% psychology. Therefore, you need to put yourself in a position where you remove the emotional stimuli from trading by repeating the same process again and again and again. Same process with the same variables, with exactly the same way that you're looking at the market, with the same context. This will allow you to remove the emotional stimuli and be mentally tough when it comes to your trading career.